two or three more classes left for this session, but the topics are broad, so we got to get going to it, right? So I want to start off with this. Hold on. All right. This right here, okay? This right here happened yesterday, right? And usually when the Federal Reserve slashes interest rates, right, they only do so because they feel something's up, something's about to go down, right? Take a look at this. Last time they began the cutting cycle, what happened during that time? 2007, 2008. You had a crisis, you had a recession, right? Take a look at 2000 when they did the same thing, when they began slashing interest rates. They usually preempt a recession about to take place, right? And that's what they're feeling right now. Although they didn't directly say that. Obviously, they said that this was an insurance rate cut yesterday because global economy is slowing down and investment is slowing down. They felt the need to slash interest rates to preempt any additional weakness that will be brought up in U.S. data going forth. All right. Now, after they said that, they also hedged themselves by saying that there were not going to be any additional rate cuts going forward. In addition to that, they also, stated that they were data dependent, right? So any further actions from the Federal Reserve will be data dependent, and that they are not setting the markets on a interest rate cutting cycle, right? In which they are going to be slashing interest rates on a every 3 month basis, right? They basically said to the markets that this is an insurance cut, and we don't intend to do any more, but we're going to be looking at the data to see if we need to do any more. As a result, you started to see everything move like crazy in the markets, right? So, I mean, it doesn't matter if you're trading like, Micron. Look at Micron Technologies yesterday. This even sold off, right? Yesterday. If you take a look at all the major products that we trade, look at the US dollar. US dollar burst through these levels, traded higher. Euro cracked through these levels, traded lowest level since 2017. British pound, same thing, lowest level since 2017, and we're heading towards a Brexit low. Remember what I said on Tuesday, that the British pound was going to go to 120. Look, we're not too far away from 120, right? We're about 110 pips away from 120. So very, very big things happening. The yen. So the yen on a short-term basis rallied here off of the Fed event yesterday, rallied even more at night, but then something interesting started to happen. I'm going to discuss this later. Something interesting started to happen, okay? I'll discuss that later. CAD, same thing. CAD hit the event, trading down here, and then, CAD fucking started going way, way higher, right? Off of the same issues created by the Federal Reserve, where CAD just started doing this, right? And I was lucky enough to get in on some of this trade. I made some money off of that trade. Australian dollar, same deal. Australian dollar is going towards the lows of 2019. This here was caused by a flash crash, right? But look at this. We are now starting to approach this level right here of 67.5 on the Aussie dollar. Stock market had the biggest squeeze ever yesterday. This is a wild shakeout. This is one of the reasons why I always said, for those who are trading stocks, you got to be cautious because stocks are very wild, right? Look what happened. The event caused, let's go to a smaller time frame. The event of the Federal Reserve slashing interest rates did something very interesting, right? It caused the stock market to go down because the Fed was slashing interest rates, which basically meant short term that the Fed is worried about the economy. But then you can argue that lower interest rates makes the stock market goes up. And so the stock market did this. And then eventually by today in the morning, it went right back to these levels where it started off, right? And it traded right around here, right? Which is very interesting because if we erase what happened today, you could say that the stock market would rebound like crazy after yesterday's Fed event. But that's not the case. And we'll discuss that in a little bit. Other market that was interesting, oil. Where are we? Here. Oil was another interesting market yesterday, simply because it was very low in terms of volatility all day, even through the DOE data. It was very, very low in terms of volatility. And then today, off of that same tweet that Trump gave later, oil just crashed. And it was, I think this was like the biggest move in oil for the year. So oil pretty much crashed really, really hard, right? And you can see here on a big picture, like look at that candle, like damn, that's a big ass candle, right? So in hindsight, the Federal Reserve rate cut, it was positive for the US dollar simply because of three factors, right? The rate cut was number one, very well priced in. Number two, there were two dissenters, two people argued not to hike interest rates at that meeting, right? And that's considered a bullish sign by the markets. And number three, the chairman of the Federal Reserve, Jerome Powell, he basically stated to the market that this was either going to be a one and done or they were going to wait and see for data and then react, right? And they're only cutting today because it's an insurance cut. That's what caused the US dollar to rally up high, right? For the stock market, as I've always mentioned, the stock market is like you got to buy the dip, right? If they're slashing interest rates, the stock market should be buy the dip opportunity. And it would have been a buy the dip opportunity had it not been for Trump today. Like, look, this was the interest rate cut. This is the market buying everything back right to that level. And then the news of the Trump cut just caused everything to collapse, right? So the stock market, buy the dip opportunity. The bond market sold off and then it was going lower, but then something interesting happened today. Let me show you guys this right here. This is my risk chart, right? I have the S&P 500, 10-year US Treasury note, Japanese yen, and gold right here. And I noticed something very, very interesting this morning with all these products, all right? So you guys can see here, take a look. Take a look here, okay? Take a look here. There was something strange taking place in the markets today, right? And this is why every time you get a tweet or something like that, I'm not surprised, right? Because if you watch specific markets, you can understand that, man, something is off, right? That's why, Mo, when you were trained today and I said, you know what? I feel like something's off today, right?
Yeah.
I had a feeling something crazy was going to happen, right? And this is my clue, okay? Remember, the bond market is a smart market. Mo, we're going to discuss the bond market in your Monday, Wednesday class very soon, but the bond market, just know it's a smart money market, right? And this market, okay, started doing this. 3 a.m. in the morning, this market started going up, right? And people buy bonds when they know shit's about to go down, okay? So you see 3 a.m., bonds go down. By 9 a.m., bonds are still going up. By 10 a.m., bonds are still trading high. And then bonds are hanging out right here from 10 to 11, 12, 1. And then boom, that tweet comes out. And then the bond market spikes up like crazy right here, right? And obviously the bond market spikes up like crazy because it's a safe haven product, right? When shit goes down, the market goes into safe haven, which is why a safe haven product like the bond market or the 10-year US Treasury note gets bought up, okay? Now, look here at the correlation between bonds and Japanese yen, okay? US dollar and Japanese yen, right? Again, 3 a.m. in the morning. So hold on, let me go to a 3 a.m. in the morning, okay? 3 a.m. in the morning, right? After this, okay? Remember, we just had a rate cut in which the market viewed that as bullish for the US dollar, right? And so you see overnight what began to happen, okay? The aftermath overnight, the dollar peaks and begins to slowly correlate with the bond market. So dollar sells off, yen rallies, and begins to slowly correlate with the bond market, okay? Slowly correlate with the bond market. And then it kind of trades around here around 9, 10 in the morning. And then boom, the news comes out around this time. Hold on. There. All right, so the news comes out around this time right here, causes Japanese yen to skyrocket or the dollar to sell off like crazy, okay? Here's the strange anomaly that's taking place, all right? The stock market. Now, the stock market is where a lot of traders are trading, right? It's a very popular market. But look what happened to the stock market. The stock market is doing the inverse of what the bond market is doing. All right. So the bond market and the Japanese yen is flagging you and signaling you that the safe haven market is pricing in some type of risk, where the stock market is trading here sideways and then it starts to slowly rebound and disregard what's going on in these two markets, in the Japanese yen and the bond market. Disregards that. By 9:30, when the market's open, you start to see a big rally in the stock market. Okay, stock market's going up back to yesterday's level, and then by 1, when that piece of news came out, stock market just crashes, right? And this is the normal correlation you see. This crash around 1, this is what happens in the markets, okay? When there is big news in the markets, bond goes up, stocks go down, yen goes down, right? And gold obviously goes up, okay? Now, this is the anomaly that I was seeing, that I was referring to. So you can see here, this was telling me something was going on in the markets, okay? This here was telling me that something was going on in the markets, okay? This here is telling me, what the fuck is the stock market doing? Something doesn't make sense here, because yen and bonds are telling you that the market's going to safe haven while stocks is still rallying. So that to me was like, something's up, okay? And then when that tweet came out, it was almost as if, dare I say, it's almost as if somebody in the markets knew that Trump was about to increase tariffs on China, right? If you look at this and you see, why would the bond market creep up 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 in the morning and then spike up higher if this piece of news wasn't front run, if this piece of news wasn't leaked to institutional investors already, okay? That to me was like, something was up, okay? Now, what I found really interesting though, here, take a look at this move right here during this time, okay? During this time of 6 to 9, where yen and bonds are moving up higher, right? Take a look at this. Look at gold. 6 to 9. Gold does fucking nothing. The gold market fell asleep, and then when it woke up, it moved $40 to the upside, right? How would you know? If you understand these correlations, you know that if yen is going up, dollar yen is going down, right? So if this currency pairing is going down and the bond market is going up, what the fuck is gold doing here? Gold should not be here, and you know that if the correlation is right, one of these markets is off, and one of these markets presents you an opportunity, right? If you take a look at this, by 9, when you start to see, by 9 right here, when you start to see the bond market trading higher, right? By 9, when you see the yen still moving lower, right? Right? By 9, this here was just whacked. This here is whacked in correlation. You can't use this. But my point here is that by 9 a.m. in the morning, when you see yen and bonds moving and you see gold doing this, like, what the fuck is gold doing selling off? You should have been buying gold. That right there would have present you with a $40 opportunity to catch in on gold, right? Vice versa, you could also look at the stock market and be like, something is up in the stock market, right? Something is up in these markets, right? And I'm very skeptical of this White House simply because look at the White House administration all-star, okay? You got Steven Mnuchin, who's the Treasury Secretary. You have Larry Kudlow as economic advisor, and you have Wilbur Ross as a economic council member, okay? You know what all of these guys have in common? They all served a high-level position for Goldman Sachs. Right? When you understand that, and then you look at the markets and you begin putting the pieces together and seeing like, man, safe haven market is acting weird. Yen is acting weird. Bonds is acting weird. What the fuck is gold doing? Why is gold so slow? What the fuck is stocks doing? Why are stocks doing this when the risk market is off? Something weird was up, right? And that's how I knew that something big was going to happen. Now, I got screwed today because I was in my CAD trade, and even though the markets was behaving a little bit weird, I got greedy and I still add more to my position, and that's where I kind of got screwed, and I had to close out. So that's why I kind of messed up on that positioning that I showed you earlier, Mo.
Mm-hmm.
I should have trusted my instincts, but I didn't. You know, I put on a stop loss, and I had to go to the bank and do some stuff, and then when I came back, all I saw was just crazy moves like that in the markets, right? And it was just fucking. I was like, should have known. Should have known. It was my fault. It was not the market's fault. It was not Trump's fault. It was my fault for not trusting my instincts and looking at the markets and saying something is up, right? Like something is up in the markets, right? Like I'll tell you right now, okay? You see this? Right now, even though it's very low liquidity, you see this technical pattern right here on stock market, right? If stocks is going to go lower, this technical pattern here, does that look like it's going to go up or go down?
Up.
It's going to go up. There's no way yen is going to go up if stocks are going down. The yen should be doing this, right? So if you're basing your trade off of, let's say, for example, if you look at the stock market and you think, man, this is technically very weak, you should not be going long dollar yen. You should be going short dollar yen because these markets are extremely correlated and they will drag each other, right? That's the idea of understanding and using correlations in the market. So it's a very, very strange activity taking place today, right? Which caused that to happen. Now, the reason why I'm super, super pissed at my CAD trade is because I got in here. My first position was in here, right? And when the markets did this, I was laughing. I was like, fuck yeah. When the market pulls back, I am going to add more. So the markets pull back after ISM, roughly around here, I add another position, right? And then the markets move lower, I'm like, yes, perfect, I add another position. So I pretty much had a 0.5 lot here, and then I did 0.25 and 0.25, right? Unfortunately for me, I went to the bank and then the markets did this and went down here right where my stop loss was, and it took me out. Right. So it took out this trade and it took out this trade. And so I ended up losing more money on that trade. And I still had this one. So by the time the markets came back up to here, so I still had this position on, right? By the time the markets came back up to here, I had to close that out. And I had to close that out. And I'll show you guys here. So all the positions are gone, but I had to close that out simply because I'm trading someone's account. And the balance was at $5,000, right? And so I was down about $300, and so the position that I got, the first position that I got on CAD, I had to close that out to bring my account back up close towards 5,000. So I was like, yeah, fuck. I kind of screwed up on that trade. I'm a little bit disappointed, but I had to close out that CAD trade. Even though I had a great position, I had to close out that CAD trade simply because it's their money, and you know, I need to be more responsible for it, right? Just to let you guys know, this company here. So this company here, they offered me a $5,000 trading account to trade for them. So that's what I'm basically doing right now. So I'm trading someone's money right now. Yeah, they just, you know, they gave me the flexibility to execute trades, and they're like, yeah, they want to see how fast I can double this account for them. So that's what I'm going to try to do within like the next 3 or 4 weeks, is try to double their money for them using some trading strategies. Yeah, I'll update you guys on that journey as I try to double this account for them, and then we'll see where it goes from there. But yeah, that's pretty much what I'm doing right now in terms of trading for these guys. If you guys are interested, and you guys have good results you can prove, I can also introduce you guys to them because they are looking for more traders to give capital to. And you guys can also trade their money if you want to for a profit sharing split. I don't know if is anybody interested in that?
Yes, but not now. Got to get good at this.
Oh yeah, you're gonna have to show them some results. So yeah, definitely, you know, develop your skill, and then once you are confident enough that you understand the market and you know what you're doing, I can definitely introduce you to them and then put you on the same thing as them. And if they like the results, you know, they'll give you money and you can trade their money for a profit sharing split.
Cool.
All right. Okay, So next thing I want to show you guys is this right here, right? So we are now on the first interest rate cutting cycle, so to speak, for the first time in 10 years, right? Not since 2009. So 2009 was the last cut that we got, right? Yesterday, we've got a Fed rate cut, even though the Federal Reserve says it's like a one and done or they're going to wait and see. When you cut, you basically set momentum for more cuts, right? That's what basically happened, right? So we went from an interest rate cutting cycle, or the last recession, to interest rates being at zero. So for the last 10 years, just rewind the last 10 years of your life, you lived through this era where interest rates were at zero. Okay. Since 2016, we're on this era of financial markets where interest rates were going up. Right now, we're on a new cycle in interest rates where interest rates are starting to go down. Right, and when interest rates are starting to go down, right there, it does some interesting things to the market. So if you guys watched that video that I posted about how the machine works by Ray Dalio, he explains how interest rates they go in cycles and they affect the markets. Right. We are now on a cycle in which interest rates are being cut in the market, and that's going to provide some interesting trading activities to take place. Right, I think the market will probably go a little bit higher. Again, it all really depends on Trump right now. He's the guy that's holding the markets up. If it were to be dependent upon the Federal Reserve, lower interest rates would cause the stock market to keep running higher and higher and higher. But as long as you get Trump tweets like this, he's going to cause the markets to move like crazy, right? So it all really depends on Trump right now. The U.S. dollar right now is really feeling the heat of trade tariffs. So trade tariffs is causing the markets to think that there is risk, right? And as a safe haven product, the U.S. dollar would tend to strengthen against certain currencies and weaken against other currencies. We'll discuss this we did discuss this in the Forex class. But that's how you got to begin positioning yourself right now in terms of trading the markets, that you got to look at the context of the environment and what's happening right now in order to get a really strong sense of how to position yourselves to trade these markets. Okay, so any questions so far before we jump into today's session?
Yes, the tariffs. I was wondering, like, I don't know if I forgot or something, but like, why is it bad for the state? Aren't they making more money off the Chinese?
Yes, but man, you gotta understand, it's a global economy, man. This is why I posted this book here, this audio book here, right? It'll explain to you the relationship of how economies work, right? Currency wars hurt everybody. Not one country benefits, right? It's like a game of like hot potatoes, right? Like, imagine if I'm holding a hot potato and it becomes too hot for me, right? I'll pass it on to the next person to hold on to it, all right? And then that person will hold on to the hot potato until it becomes too hot, and then they'll pass it on to the next person. And it just goes on in circles like that, right? It just goes on in circles like that. That's how inflation in the global market works, okay? One country experiences inflation while another country experiences deflation. Case in point, when the US dollar is strong, right? When the US dollar is strong, that means US country, right? They are going to be experiencing inflationary pressures, correct? Right? If the dollar is strong, that means that everybody wants more dollars, right? If they want more dollars, it's going to increase the value of the US dollar more, right? And in the way the currency works, if the dollar is strong, that means all other currencies are weak, right? So that basically means that the US will experience inflationary pressures from the dollar being strong, but then all the other countries like Canada, like Australia, like China, like Europe, and their currencies, because they're weak, they will experience deflation, right? And then that deflationary pressure, for a period of time, it begins to make their stuff attractive, right? What happens when the Canadian currency is low for a period of time? That makes our exports more attractive. No, we can sell more oil, we can sell more lumber, we can sell more maple syrup, right? It makes it so that people will want more of our goods simply because the Canadian dollar is cheaper. So there'll be more. The U.S. will be more likely to import more oil and import more maple syrup, right? And import more, beavers. I don't know, like whatever the hell Canada produces, right? That's the general idea. Is that when our currency becomes cheap, it creates more demand, and then that demand eventually pushes up inflationary pressures. That's why the concept of the hot potato is very important to understand. As our stuff begins more and more demanded in the markets, it begins to increase inflationary pressures, right? And then that's where the tide begins to tip. So the Canadian dollar becomes more and more sought after in the markets, and then the US dollar less so. That's why there's that back and forth relationship, that hot potato relationship in the currency market. Listen to this audio book by James Rickards, right? He will explain this concept of how currency wars works in the markets. But this is the reason why inflationary pressures around the world gets pushed back and forth in a circle, right? And it is why you can't have monetary policy that benefits one country all the time, right? It benefits you for a certain period of time, and then eventually the market will shift because goods from one country becomes more expensive and goods from another country becomes less expensive or cheap, and then everybody will just start moving towards that country with the cheaper goods and away from the country with the more expensive goods, right? So you have this cycle taking place within the markets. It's a very important concept to understand when it comes to financial markets. And the reason why the Federal Reserve yesterday said that their interest rate cut was an insurance rate cut because of global events, right? The Federal Reserve is responsible for monetary policies for the United States of America only. They make adjustments to monetary policies to help the U.S. economy grow. If that were the case, why would they care? Why would they care about global factors, right? The reason why, the answer to that is because they understand that the U.S. economy and the U.S. dollar will have global impacts on other economies, which would then come back and bite them in the butt if they don't act, right? That's why they gave the logic and the reasoning that they did at yesterday's meeting. They said that it was an insurance rate cut because Europe is slowing down and China is slowing down, right? And because of that slowdown, they're going to be slashing interest rates because they're anticipating that the slowdown in Europe and China and emerging markets will create less demand for U.S. goods. Less demand for U.S. goods, right, will eventually pull down U.S. economic growth, right? Pulling it down, and that is why they're reacting today preemptively. Okay.
Okay.
Any other questions?
No, that's it for me.
No? Okay. So let's move into this and begin understanding the roles of the Federal Reserve and the roles of central banks, and then move into understanding the Federal Reserve in general. Okay.
Okay.
So these are all the topics that we're going to be covering today. When it comes to monetary policies, right, from governments, they fall into two arms. Okay. You have monetary policy and you have fiscal policy. Okay. Yesterday was the perfect case of monetary policy. A central bank using the tools that they have available for them to create movements in the markets, right? And by now, if you don't understand this, this institution is so powerful that it doesn't matter which asset class you're trading. The Federal Reserve will affect every single asset class. So stocks, doesn't matter. You look at like Apple, Beyond Meat, Tesla, they were affected by the Federal Reserve. You look at the bond market, they were affected by the Federal Reserve. You look at the Forex market, they were affected by the Federal Reserve. You look at the commodities market, they were affected by the Federal Reserve. That's how powerful monetary policy is. That's how much power one central bank has over the entire global financial markets, right? They have the ability to cause trillions of dollars in assets to move around based upon what they do, right? That's monetary policy. Fiscal policy comes from the government, right? Or more comes from the, I would say the White House, from Trump, right? Trump is like the only president who actually uses fiscal policy to move markets, right? And today was a great example of fiscal policy right here, right? So you can see the stock market just completely crashing today because Trump came out and he's like, yeah, we're going to put another 300 million or $300 billion in tariffs on Chinese goods. And this came out of nowhere. This caught the market by surprise because the market was under the impression that everything was all good and gravy, right? You remember the last G20 meeting that took place in Argentina back in like late June, right? After that meeting, everybody thought that, man, like Trump and Xi, they're buddies again. You know, they're talking, they're friends, and everything was good. And then all of a sudden today, out of nowhere, he dropped a bomb on the market, and that bomb caused the stock market to lose like a good 50 points. Like if you were trading the S&P 500, you could have caught a good 50 points in the market off of that one move, that one tweet. And that's a perfect example of fiscal policy, right? So these are the categories of government policies that affects the market: monetary and fiscal policy. Monetary policy is more done by central banks. Central banks are responsible for monetary policy. And the way that they use monetary policies is in several ways, okay? So first and foremost, they use what is referred to as forward guidance, right? Forward guidance is just a financial market concept of a government or a company. It could be like Apple. Apple will tell you in the next quarter, we plan to sell 5 million iPhone X, right? That's Apple giving you what is referred to as forward guidance, right? Netflix saying that we tend to add 1 million new subscribers in the next quarter. That's forward guidance. It's setting the expectation for how a business is expected to be run. If Tesla tells you they're going to sell, 100,000 Model 3s, that's Tesla giving you forward guidance, okay? When it comes to central banks, they will give you forward guidance in the form of, we intend to keep interest rates at this level. We intend to hike interest rates to this level, or we intend to cut interest rates to this level, or we intend to increase or decrease the money supply. That is central bank forward guidance. Now, central banking forward guidance is probably the most convoluted subject ever, because no central bank ever comes out and directly spells out to you what they intend to do. Right? They are very guarded with the way they speak, and this is referred to as bank speak, right? Imagine if you're a person with the ability to move trillions of dollars in financial market assets with just what you say, right? That's the reason why they use bank speak, right? They don't, clearly say what they intend to do, right? They wrap it up in terminologies and things like that. They'll say things like, we are data dependent. We're experiencing headwinds. We're experiencing tailwinds. Like what does that even mean? That's a very common phrase used by central banks. Do you guys know what that means? We're experiencing economic headwinds. Do you guys know what that means?
No.
Right. So exactly. You're not supposed to. They don't want you to know what that means, all right? But people in the markets have developed what is referred to as bank speak, right? And bank speak is just a way of interpreting central bank jargon, right? It's like, how when you talk with your buddies, you guys have like your own slang, your own, your own words that you say, your own sayings that you say, right? That's central banking world. They have their own things that they say, right? And when it comes to understanding and interpreting news-driven events by central banks, you have to understand their language, or you will miss out on opportunities, or you'll get screwed because you're in a trade and they blindside you with like something like they'll say something like We're experiencing tremendous headwinds from global markets, right? They'll blindside you if you don't understand how to interpret some of these statements. Okay, so that's the idea of forward guidance. It's telling or setting the expectation for what markets are or what they intend to do. Okay, next ability that central banks have is interest rates. They have the ability to hike or cut interest rates within the markets, right? Hiking and cutting interest rates will have a direct impact on financial markets, right? And you have to understand the impacts of interest rates on markets, right? So when you take a look at this variable here, and you take a look at the market for currencies, when interest rates go up, okay, that's positive for the dollar. When interest rates go down, that's negative for the dollar. For the stock market, when interest rates goes up, oh, let me redo that. Sorry. So for here, for the stock market, when interest rates goes up, stocks goes down. And when interest rates go down, stocks go up, right? For the bond market, when interest rates go up, bond prices move higher. When interest rates go down, let me rephrase that. When interest rates goes up, bond prices moves lower. And when interest rates go down, bond prices move higher. Sorry for that. That's my mistake. Okay. And for the commodities market, okay, you got to understand that the commodities market trades in US dollar terms, right? You don't buy gold in Canadian dollars. You don't buy oil in Canadian dollars. You don't buy soybean bushels in Canadian dollars, or corn bushels, or wheat bushels, or cows, or pigs. You don't buy any of that stuff in Canadian dollars. All commodities trade in US dollar terms. And what happens to the US dollar when interest rates goes up? What happens to the US dollar when interest rates go up?
It goes down.
When interest rates goes up, the US dollar goes up.
Oh.
Right? Higher rates means the currency is more sought after, right? Now, when you compare that to the commodities market, right? Take a look at this, okay? If the US dollar goes up, remember in the Forex market, you have like, US dollar, that's your counter pairing, and then your CAD is your base pairing, right? When interest rates goes up, US dollar becomes stronger, the other currency becomes weaker, correct?
Okay.
That's how the Forex market works, right? And in the commodities world, when the US dollar becomes stronger, that's basically what happens. Dollar goes up in value, oil decreases in value, right? That's what basically happens. So there's a pressure simply because the dollar is increasing in value that depresses the value of the commodity that's trading against it. So that's how interest rates have a direct impact on all the major markets that we trade. All right. And then lastly, they're also responsible for the money supply, right? So they have the ability to print money, right? So they can increase or decrease the supply of money however they wish, they see fit, all right? And that's, the main tools of monetary policies, although they get into more detail, which we're going to discuss in a little bit. From the fiscal policy side, this is the government side, right? This is what like Trump controls. This is what Trudeau controls. This is what Kim Jong-un controls. Probably he controls a lot more. But again, in a democratic society, governments control fiscal policies. And fiscal policy has more to do with taxation and government spending, right? So taxation is, you're taxing citizens and you're taxing corporations at a specific rate. Government spending is, when you take in that money, what do you spend it on? Governments will spend it on, military infrastructure, education, investments, and things like that, right? When governments take in less money than they spend, that is called a budget deficit. When governments take in more money than they spend, that is referred to as a budget surplus. Every single government, I think over like the last 20 years, has run a budget deficit. That means that they spend more than what they take in. It's like saying, you spend more than what you make, right? You say, how is that sustainable in the long run? Technically it isn't for you, but for a government that has the ability to tax citizens, they can increase the tax at will, right? So let's say, for example, um, you spend money on your credit card, and you keep spending more than what you make, right? In order to balance your debt, you'd have to make more money. For governments, in order for them to balance the debt, they would have to tax people more or spend less, right? And that's pretty much the way that it runs. But each one of these arms here will have a direct impact on financial markets, as I've showed you guys earlier. Okay. Now, what is a central bank? So, central bank's purpose, they act as the reserve bank or the monetary authority board for the country. And they basically manage the country's currency. So, they manage, like fighting fraud, fighting counterfeited currencies. They issue supply of the currency. They change interest rates, and they set monetary policies and rules and regulations for how the financial system works in that country. That's pretty much the primary role. Now, good central banks around the world have to be independent, they have to be credible, and they have to be transparent, right? And what I mean by good countries or good central banks is they need to have these functions in order for them to have volatility in financial markets, all right? What I mean by that, furthermore, is this, okay? Take a look here. Does anybody trust the CBR, the Central Bank of Russia? Right? Does anybody trust the Reserve Bank of India? Does anybody trust the People's Bank of China or the Brazilian Central Bank? Right? That's what I mean by the market needs to take in these three things. Central banks need to be independent, they need to be credible, and they need to be transparent. So when you look at this here, you say, is the Chinese Central Bank independent? No, they're not a democratic society. Is the Central Bank of Russia transparent? No, they're not very transparent, right? Is the Reserve Bank of India credible? No, they're not credible. Is the the Brazilian Central Bank, is it independent? No, they're not independent. So if you follow that logic, you'll see that certain central banks have very little impact on the markets, and other central banks will have a large impact on the markets simply because they follow those three principles. For the most part, all the major central banks that are very good and tradable are right here. Right? You have the Federal Reserve, the European Central Bank, Bank of England, Swiss National Bank, Reserve Bank of Australia, Bank of Canada, Reserve Bank of New Zealand, and the Bank of Japan. These are all the major ones that you want to look at. When they act, they will move their currency. And if you take a note of this, Japan, New Zealand, Canada, Australia, Switzerland, England, and the Eurozone, these are all the major currencies around the world, right? So like the Euro, the Pound, the Swissy, the Aussie, the CAD, the New Zealand dollar, and the Japanese yen. Those are all the major currencies that you can trade around the world, right? That's why you want to focus in on these major central banks. And we'll discuss more of these guys when we talk about international central bank next class. But today's focus is going to be primarily on the Federal Reserve. Okay. Last point here to understand is that central banks typically oversee the commercial banking system of their country, and they have the economic power to prevent financial catastrophe, such as a run on the banks, right? So if you think of it like the Bank of Canada is the central bank of Canada that oversees all the five major central banks, like all the five major banks, such as RBC, TD, Scotia, BMO, CIBC, right? The Bank of Canada is responsible for setting the rules and regulations in which these five major central banks operate within Canada. That's their role. All right. Central banks also act as a lender of last resort during times of crisis. So what that means is that if RBC or CIBC or BMO, they run into liquidity troubles, like they don't have money in their accounts to give out to all the depositors that deposit money into their savings account, what's going to happen is that the Bank of Canada is going to step in and they're going to give that bank money so that they can provide liquidity to the people who have deposits with that bank. And that essentially safeguards the financial system from not collapsing on itself. Now, some central banks act as the safekeeper of the country's reserve assets, meaning that they hold gold, they hold investments, they hold foreign treasury notes. So like treasury notes from like the United States is the most popular one. And they also hold other currencies, primarily US dollars. Right, so they basically act as like the piggy bank for the country and the investor for the country by doing that. And then most importantly, most central banks act independently of the government, allowing them to set the monetary policies for the country without interference from current political party or fiscal policies that may be implemented by that government. So what that basically means from the Fed perspective, right? Let's take a look at the United States, okay? The Fed controls this, okay? Trump controls this. All right, and the way it works is that Trump has zero influence on the Fed, right? The Fed has a goal stated by mandate, or sorry, the Fed has a mandate stated by Congress, right? Like their purpose, the reason, right? And that purpose and that reasoning is given to them by Congress. Once they have been stated their purpose by Congress, they are given these tools, forward guidance, interest rates, money supply, to achieve the mandate. They have a zero accountability or just basically zero accountability to Trump, right? Although I have to say this, okay? This is the first time ever that I've seen this in the last 8 years that I've done this, right? So I've been monitoring the central bank during the Obama era and during the era when Janet Yellen was the president of, the president of the Federal Reserve, okay? During that time, Obama let the Federal Reserve do its thing to help the economy grow. And Obama never interfered with the Federal Reserve. Trump, this guy is fucking something else, okay? This guy is like, like you turn on the news. This guy, like, I literally turned on the news the other day and I saw a piece of news saying that Trump said he was at 9/11 ground zero helping firefighters, assisting firefighters getting people out of 9/11 when the 9/11 attacks happened. Like when I saw that, I was like, this guy's fucking something else. Like, can you believe the things that he'll say, right? So this is the environment that we're working in, right? And so right now on Twitter and social media, Trump has been going after the Federal Reserve, right? You have to understand the way the structure works. Trump has been criticizing the Federal Reserve for not cutting interest rates enough to help the U.S. economy, right? But the thing that most people don't know is that Trump has no say over whatever the Federal Reserve decides to do. And the Federal Reserve has zero accountability to Trump. The only time those two branches of the government mix is during this, okay? Okay, this is the only time the two branches mix. So back in 2017, okay, so let me remove this, okay? Look here, Trump announces Jerome Powell as the new Fed chairman, right? So there's just one time in which the two branches of government mix, right? So this is fiscal policy, this is monetary policy. They're supposed to act independently of one another, right? They have no bearing over each other. There's only one time in which the two will have bearing over one another, and it's during this. It's during the election of a new president or of a new chairman of the Federal Reserve. So government, i.e. Trump, has the ability to elect this guy as president. So that's exactly what he did. Back in 2017, late 2017, Trump handpicked Jerome Powell to be the Fed chairman. All right. Now that Jerome Powell is the Fed chairman, he has his rules and his goals stated by Congress, and he's using those monetary policy tools to help the economy grow, despite what Trump's doing with fiscal policy. And he has no accountability to Trump at all. So that's basically what he's been doing now. Right? So that's the only time those two branches of government will mix with one another. Okay? Is that clear so far?
Yeah.
Okay, we're going to revisit that in a moment. Okay, couple of other things that you guys should know that's general to all central banks is this two concepts. You have the concept of easing and the concept of tightening. Okay, easing and tightening monetary policies is something done by all central banks around the world. So in an easing cycle, monetary policy easing is meant to help economic growth by making capital, money, more available in the system. It makes credit cheaper so people can borrow at lower interest rates, and that's meant to stimulate the economy in an easing cycle, okay? Guess what the Federal Reserve just did yesterday? They slashed interest rates. They're easing monetary policy, and that's their intent. They're trying to help spur economic growth. Monetary policy easing can also become a catalyst for inflation, right? How does that become a catalyst for inflation? Well, what happens when people borrow more money? What happens when capital is more cheap in the system? Right? What happens if, Steve is able to borrow more money from RBC? Or what happens when Mo has more money to spend? You spend it on the economy, and that, in the long run, is supposed to help grow the economy or lead to inflationary pressures. Does that make sense?
Yeah.
Right? That's what easing monetary policy does. So when a nation floods its system with easy credit via low interest rates or floods a market with more money supply, it is hoping that the economy will expand or grow. That is the intent of an easing monetary policy. Okay? The opposite is tightening monetary policy. So in a tightening of monetary policy tightening is meant to slow down economic growth by making capital less available in the system. Credit is more expensive to service due to the higher interest rates, and as a result, spending slows down, right? It's like saying, your credit card is 19% today, tomorrow it's going to be 25%, right? Are you going to have more money to spend on, going out to eat and things like that? No. Well, that's the intent of tightening monetary policy. Monetary policy tightening can lead to a deflationary environment when the economy is growing too rapidly, right? So when the economy is growing too much, they'll resort to monetary policy tightening to help slow things down. So when a nation reduces the money supply via high interest rates or reduces the dollars circulating, it's hoping the economy will slow down and contract. Right? That's the intent of monetary policy tightening versus easing. Okay? Now, take a look at this chart right here. All right? Take a look at this chart right here. Okay? So this is where interest rates was at. Okay? We were at 2.5, correct? Yeah? Okay? If the Federal Reserve signals that we are at 2.5% interest rate, okay, and the economy is overheating, we're growing too much, what type of policy would they lean towards if the economy is still growing or still inflating, still expanding too fast? What policy will they lean towards? Tightening or easing?
Like if the economy is growing too fast.
It's still growing, it's overheating, and they want to slow it down. What policy? They would tighten. Okay?
Okay.
Right? If they signal this, what would happen to stocks? What would happen to dollar? What would happen to bonds?
Stocks go down, right?
In a tightening monetary policy, you are correct. What would happen to the US dollar?
Go up.
Goes down.
No.
Goes up.
Goes up. Interest rates are going up. They're signaling that they're tightening monetary policy. It goes up. What would happen to bonds?
Goes down.
Perfect, right? Higher interest rates leads to bond prices moving lower. Perfect. Great job, Mo. Okay? Now, guess what just happened? What just happened yesterday?
They
eased monetary policy. They went from 2.5 to 2.25, right? So they went this way, right? And in this scenario, what would happen to stocks? What would happen to bonds? What would happen to Forex, right? The same idea. You need to understand, first and foremost, in the markets, where are we? Where is interest rates, okay? That is where you have to figure out where your bearings are in the cycle. Next thing you want to do is, okay, if this is where we are, where is the policy going to go? Towards tightening or easing? And these two scenarios will give you an understanding on how to position yourself to trade, okay? Next thing you want to know here is, where is inflation, right? Because the idea here is that interest rates is supposed to counteract inflation, right? They want the economy to grow, but not grow too much. They want inflation rate in the range of like 1 to 3%, right? And in order to help the economy get to 1 to 3% inflation, they use this tool, interest rates, right? And so in order to get interest rates, or in order to get inflation within this target range, they'll use this policy or this policy to help the economy grow to there. Okay? Now, when interest rates and inflation rate are roughly the same, this is where we have zero, right? This means that the growth in the economy is counteracted by inflation and interest rates being at the same rate. Okay? That's where the zero comes from. Okay? Does that make sense?
Yes.
Okay. One more concept about central banks before we move into the Federal Reserve. Okay? You guys are all aware of the concepts of bulls and bears in the markets, right? Like, please tell me yes.
Yeah.
Yeah? Yeah, you guys all understand bulls and bears, right? A bull charges up, or they swing their bull horns up in an attack, and a bear swings his claws and his paws down in an attack, right? That's why the market is referred to as bulls and bears, up or down, okay? That's very simple. We all know that. Bull, bears, we all know that. Very, very simple, okay? What 90% of traders don't know in the markets is the concept of hawks and doves, all right? Have you guys heard of the concept of hawks and doves before today?
Nope.
Yeah.
You have, Mo?
Yeah, I've seen it. I came across it a couple of times.
Oh, you came across it. Okay.
Yeah.
Anybody else, like Steve?
Nope.
No? Tyler? Nan?
No, never heard of it.
All right. So this is the concept of hawks and doves. Let me explain, okay? So as I mentioned earlier before, right, central bankers have like their own jargon, like their own language that they speak, right? And the market will always take the context of what they're saying, and they will categorize it as a hawkish comment or a dovish comment, right? And the hawkish or the dovish comment basically leans towards whether they are signaling to the markets that their comment is going to be easing or tightening of monetary policy. Okay, so let me explain this a little bit further here. when a central banker believes that the economy is growing or it's growing too fast or they're optimistic about the economy, right? They will be more likely to be leaning towards a more aggressive tightening monetary policy, right? And so when it comes to the concepts of hawks and doves, a hawk is someone who basically believes monetary policy should be tighter, or they want interest rates to go up higher, or they're very optimistic about the economy. That is why they would be considered a hawk. Okay? A dove is the exact opposite. A dove is somebody who is seen as a pessimist. They think that the economy is not growing. They think that inflation is low. And because of that, they want to keep interest rates low, or they want to lean towards lower interest rate policies. That is the concept of a dove, right? And when it comes to financial markets and interpreting central banks from around the world, market participants will take every single statement that is issued by central bankers and interpret it as hawkish or dovish. So my case in point is this, okay? Let's go to the dollar index and analyze yesterday's movement, okay? We knew that the Federal Reserve was going to slash interest rates, okay? The Federal Reserve was going to slash interest rates, causing a 25 basis point cut, right? And understanding markets very well, you should know that a 25 basis point cut, lowering the interest rate within the U.S. economy, should have caused the U.S. dollar to trade lower, correct?
Mm-hmm.
Right? But look at the markets. It didn't trade lower for U.S. dollars. It traded higher. Why is that? It all came down to the speech and the press conference given by Jerome Powell. Okay, Jerome Powell came out to the markets and he basically stated to the markets that the Federal Reserve was slashing interest rates as an insurance rate cut, and that they are going to be leaning towards a one and done scenario, one cut and that's done. In that case, would that be viewed by the market as a dovish scenario or a hawkish scenario? If they're only going to slash once and they're done with it.
Would just once?
If the Federal Reserve signaled to the markets through forward guidance that today's insurance cut was going to be a one-time thing and that they're not looking to cut anymore. So the markets, knowing this, already priced it in, right? So they priced in the rate cut already. But then through forward guidance, Jerome Powell signaled that today's event is a one-time thing and we're not going to cut anymore. Would that be considered a hawkish or a dovish move?
Hawkish.
Right? How does a hawkish move look in the markets?
It would go bullish, right?
Look what happened to the dollar index. Look what happened to the value of the US dollar. Even though you got a rate cut, the signal, the forward guidance signal in the markets caused the dollar to rally, right? And this may sound weird to you guys, but take a look at any stock. I know some of you guys follow stocks, right? Like, you ever wonder why, like Apple misses earnings per share, but then they'll say, oh, but next quarter, we are expecting to sell 10 million iPhones, 5 million more than what we expected. And even though they miss earnings per share, the stock still rallies. Right? You guys ever wonder why the market does that? Is because the forward guidance, right? Remember, the market's always looking forward. They never look backwards. They always look at what's next. What's next? What's up next quarter? That's the idea of the markets, right? And that's why it's very important to understand the concepts of hawks and doves in the markets. A good way of interpreting these statements is by looking at this, okay? Let's go next week here. I believe there's a bunch of central bankers speaking next week. Let me find out. Here, you have Fed Evans speaking next week. Here's one. Fed Evans is speaking on Wednesday at noon. I believe that's just one. We're only getting one. Or maybe the schedule is too soon. Yeah, I think maybe the schedule is too soon, right? But the idea here is that you want to look at every single Fed member when they come out and listen to the way they talk about the markets, right? And a good way to become knowledgeable about how markets move off of hawkish and dovish statements is by listening to the way they talk, right? If they sound positive, if they sound optimistic about the economy, that is a hawk, right? And if they sound pessimistic about the economy, that is a dove, right? And the markets will react based off of the signals that they give. Remember, these are the oracles of financial markets, right? They control financial markets. They control your money. If they're telling you that the economy is doing good, your money is going to be worth more. And if they're telling you the economy is going to be bad, your money is going to be worth less, right? That's why it's very important, okay? So central bank speak or Fed speak is a language within itself, and you got to become acquainted to it. A lot of positions in banks, they hire journalists, they hire analysts, and their jobs is just to read these statements and then just interpret what they're saying. Just interpret what the Fed is saying. That's all they do in the markets, right? And when it comes to communication, they're constantly being scrutinized by financial market participants because imagine having the ability to move $1 million, $1 billion, $1 trillion in financial markets just by saying, you know what, the economy is not doing so good, and because of that, we're probably going to have to ease monetary policy to help it grow. And that statement there gets clued in by markets, and everything just goes crazy, right? Imagine having that power. That's just crazy. Okay. So here, I have some additional statements for you guys on dovish and hawkish statements. I'm not going to go through them. You guys can read through this on your own, but it gives you guys a sense of what a hawkish and a dovish statement would look like. I did post a slide for you guys so you guys can go over that. Now I'm going to talk more about the Federal Reserve. But before I do that, let's take like a 2-3 minute break, and then we'll come back and then we'll cover the rest, okay?
Okay.
Hello? Yeah, is everybody back?
Yeah, I'm back.
Yeah. Okay. So, first and foremost, what is the Federal Reserve? Right. The Federal Reserve, believe it or not, if you ask many Americans, and you can find this on like YouTube, like I believe like a talk show host, like a Jimmy Fallon or somebody, like he'll go out and he'll be like, "You guys know what the Federal Reserve does?" And 90% of Americans have no clue what the Federal Reserve does, which is very scary, right? For an institution that controls how money works and how financial system works in the markets, nobody has an idea what the Federal Reserve does, right? Hopefully, through this module here, you guys are going to become a little bit more knowledgeable about the Federal Reserve. Now, I'm not going to go into their history that much, so we can skip that part. But for the most part, after this, you should know what the Federal Reserve is. More importantly, its structure, what its communication policies are, and how they impact the markets that you try to make money from, right? Because it's idiotic to participate in the markets and not know the roles of the Federal Reserve and how they can affect your trades or your investments, right? By understanding this, you would at least become more knowledgeable from a macro fundamental perspective on how a important institution like the Federal Reserve will affect you, and more importantly, how you can make investments and trading decisions based off of what they intend to do to basically help you make money in the markets. So, with that being said, the current Federal Reserve System in the United States basically came into power in 1913. Now, they called it the Federal Reserve, right? Why don't they call it, the Central Bank of the United States, like the Bank of Canada or the Bank of England? No, they call it the Federal Reserve. Why is that? Is because prior to this Federal Reserve, there were two other central banks in the United States, and they both failed, right? They failed to protect the economy when a crash happened, and they basically protected the wealthy and the powerful. And as a result, citizens were more likely to disapprove of a centralized body that was controlling the money supply of the economy if it were a private institution. And so they gave it the name the Federal Reserve to make it sound more like a government institution. But the Federal Reserve is a private bank that controls all the money in the United States. It creates all the money in the United States. It has tremendous economic power over the United States, a private bank. Okay? Think about how crazy that is. A private banking structure that prints all the country's money. Not only all the country's money, but the most valuable currency in the entire world, right? And it's a private institution. It's not a government institution. It's a private institution. It's only called the Federal Reserve because it sounds like it's a branch of the government, but it's not a branch of the government. Okay? That's the first thing. The Federal Reserve has grown to become one of the most important monetary authority board in the world. And they often oversee global financial system, and they make adjustments to monetary policies based upon global macroeconomic conditions, right? Remember the insurance cut that you saw yesterday? The first cut in 10 years? Why did they cut interest rates when the U.S. economy is doing good? When GDP data is strong, retail sales data is strong, ISM numbers were good, CPI numbers were good. Why did they cut? Because they were afraid that the global economy was slowing down. That's why. Okay? So, what makes a Federal Reserve unique, right? It consists of 12 privately held regional banks. So there are 12 branches of Federal Reserve banks located in the United States. And these 12 branches coordinate with one central authority known as the Federal Reserve, right? So the 12 banks would be known as the Federal Reserve District Banks, and then the Federal Reserve itself is the Federal Reserve located right across the street from the White House in Washington, D.C. Okay? They deliberate on interest rates adjustments through the Federal Open Market Committee. All right. It's actually a very, very cool institution to visit. Have any of you guys ever been to Washington, D.C.?
Nope.
No? Nobody? All right. So,
No.
yeah, I mean, like, I'm a big finance geek, right? So I visited the Bank of Canada. I've also visited the Federal Reserve when I was in Washington, D.C. Actually, I came to Washington specifically to visit the Federal Reserve. I was more excited about that than the White House. Okay? You know what I saw out in the front lawn of the Federal Reserve? Okay? And this was like in plain sight, right? Like the White House is more discreet. Like the White House is very secure, like guarded. You know, like you don't need to see all the, you don't see all the guards there because it's a big tourist place, right? But out on it's highly secure, right? You know, you have guys that are armed and whatnot, right? But they're very discreet. You don't see them. The Federal Reserve, which is located like right across the street from the White House, there were guards with M16s walking around on the front lawns of the Federal Reserve. Like that's how crazy it was, right? Like they're just basically patrolling this office building, right? And they're holding semi-automatic rifles, and you just look at that and you're just like, wow, this is a crazy place, right? So, anyways, if you guys ever get the chance to visit Washington D.C., do check it out. It's a very surreal place because that is essentially the place where all monetary policies affect the entire global financial markets, right? So, as I've mentioned earlier, although the Federal Reserve is quasi part of the government, the Federal Reserve is independent within the government, right? This means that the Fed has the power to make monetary policy decisions without consent from government power, right? And that's the current iteration of the Federal Reserve. Now, as I mentioned earlier, there were two other central banks prior to the Federal Reserve. Its history, it's boring. It's like over 200 years ago. It's irrelevant to what has happened today, so I'm just going to skip this. This here is all the Federal Reserve presidents that have served, right? Arguably one of the most important person in the world. I would direct you to the last four presidents. So Paul Volcker, Alan Greenspan, Ben Bernanke, and Janet Yellen, right? I'm pretty sure all of you are within this age range, right? It's important to understand who was in power during the time when you were alive, right? Because the monetary policies that they've dictated created all the crashes and the booms in financial markets from the time you were alive up until now. Now, the current chairman, so this is a little bit outdated. Janet Yellen is not the current chairman. She left in 2017 and was replaced by Jerome Powell. So Jerome Powell is a new guy who's in power, and he took over for Janet Yellen. Janet Yellen was the first female president of the Federal Reserve. So what are the goals of the Federal Reserve? Their responsibilities and their mandates, right? What is the purpose? What did Congress say? This is your purpose. This is what you have to do. It falls into these few categories, okay? First of all, they conduct the nation's monetary policy, right? So they basically make policy adjustments for the country on the country's behalf. They maintain price stability, aka they control inflation, and this here is the key. Their goal is to control inflation within the economy, okay? That's the big one. That's the key role of all central banks around the world. Next one, they supervise and they regulate financial institutions, right? So this is like the Federal Reserve overseeing Goldman Sachs, JP Morgan, Wells Fargo, etc. Like all those big banks, they supervise and they regulate those guys, okay? Nextly, they foster the payment and the settlement system for safety and efficiency, right? That basically means they try to catch counterfeiters. They try to make the dollar, not counterfeitable. They go after those guys. They try to make sure that nobody's laundering money in the system. So like you don't have like guys like El Chapo laundering, making money in U.S. dollars and laundering it. That's essentially what they try to do, right? And this is probably one of the reasons why they're a little bit afraid of cryptocurrencies right now. All right. And then lastly, they promote, the financial system, and they do a lot of like community development stuff, which I think this is probably like BS. They don't really care about this. They care about these things more. Mostly this one, maintaining price stability. Okay. And you can see here, this is how they basically do it. So this is their functions, right? So they have these 5 functions that we've just mentioned here. These are the 5 functions. This is the Federal Reserve System on how it works. And then the Federal Reserve System is consisted of the Federal Reserve Board of Governors, 12 Reserve District Banks, and then the Federal Open Market Committee, or the FOMC. Okay? Now, as I mentioned earlier, their main thing is controlling price stability or inflation within the markets, right? And this is why the cycles of inflation and deflation is extremely important in the markets, because inflation and deflation basically kicks off their monetary policy decisions. So if, Mo is demanding more money from his employers, his employers just basically have to pay Mo more on salary. That increases their cost of business. And so they raise the cost of their goods and services. And then that basically causes, a cycle in which inflation is picking up. And if the Federal Reserve senses that, they're going to be more likely to tighten monetary policies. If the opposite happens, Mo's demanding money, and the company's like, no, we don't got money to pay you. In fact, we're going to lay you off. Well, guess what? Mo's laid off. He doesn't have money to pay his bills. He's not paying his bills, so the utility company doesn't get money from Mo, and so the utility company is not making money, and the cycle of deflation is kicking off in the economy. And as a result of deflationary pressures, they're going to be more likely to lean towards a easing monetary policy stance, right? So that's their primary focus, maintaining price stability in the markets. Now, the Fed's favorite measure of inflationary tools comes down to the following, all right? They look at the GDP deflator. They also look at the CPI index, consumer price index, excluding foods and autos. And then they look at the price, the personal consumption expenditure of ordinary citizens from around the world, okay? These are their 3 favorite measures of inflation that they look at. Now, inflationary outlooks, right? Inflationary outlook comes from 3 categories, okay? First and foremost, it comes from headline inflation. Headline inflation, guys, is just the data, right? So they look at like CPI, PCE, GDP deflator, rising wages and things like that. Like they see our pricing pressures, wage pressures, are those picking up within the economy? Yes or no? That's the headline inflation that they're seeing. Next thing they look at is inflationary expectation. Inflationary expectation comes from their forecast, right? So they try to forecast on whether or not they think inflation is going to be going higher or lower in the near future. And they use that and they give that in their forward guidance so that the markets can get a sense of whether or not they should be preparing themselves for higher or lower inflationary pressures, okay? And then lastly, you have inflationary pressures. Inflationary pressure comes from the commodities market and it comes from the foreign exchange market, which is why in this program, I stress that it is extremely important that you understand how all these markets are connected with one another, simply because commodities and foreign exchange markets have inflationary and deflationary pressures within the macroeconomics of things, right? The way it works is that if oil prices are high, is that an inflationary pressure or a deflationary pressure? Right? So take a look at this. Let's get rid of this here. And let's go to this. Okay? And let's go to 240. Okay? Take a look at this. Okay? Look at where oil price is. All right? Would this be inflationary or deflationary for citizens in an economy? For people in an economy, would this be inflationary or deflationary, guys? With oil prices the way that it looks now.
Deflationary.
Perfect. Right? Look at oil prices. It's been dropping, right? You're paying less to pump gas in your car. That means you are saving money. That means the gas company is losing money, right? That is a bad sign of deflationary pressures for the economy. Okay? That makes sense?
Yep.
Okay? Take a look at this. Okay? USD CAD, for the most part, has been going this way. It just rebounded, right? But for the most part, let's say USD CAD is trading here, okay? The Canadian dollar is strong, right? Forget this here. Forget this here. Let's say here. The Canadian dollar was strong going into the summer months, all right? Is that inflationary or deflationary for Canadian consumers?
Deflationary.
No, it's inflationary, Steve. And the reason why it's inflationary is because
the market's going down, then ours.
Yeah, the dollar is strong, is weak. The CAD is strong, right? That's what it's saying, right? So what it's saying here is that the Canadian dollar, our currency, has been strong going into the months of June, July, basically, right? So what does that mean? That means that it costs less for you to travel abroad. You can buy goods online and it'll cost you less, right? So that means you have more purchasing power. It's an inflationary pressure, right?
Yeah.
Okay. This is why central banks care about the commodities market and the forex market, is because when exchange rate goes too high or too low, it will cause inflationary or deflationary pressures based upon the exchange mechanism. When commodity prices goes too high or too low, it will affect the exchange rate on goods, or sorry, it won't affect the exchange rate. It'll affect the cost of those commodity goods, right? Like the price of oil or the price of wheat or the price of base metals, right? It affects everything. Like a company that uses a lot of base metals. Let's say GM, which produces in Canada, they have to buy a lot of iron ore and base metals, right? If base metal is low, that means that GM is going to be experiencing more inflationary pressures simply because they're paying less for metals to produce their cars, right? And vice versa. If the cost of metals is high, they're going to be paying more, and so they have to pass on that cost to consumers, right? Everything in the economy works as one big machine, like how Ray Dalio explained it, right? So that's the idea, is that when it comes to looking at inflation basically comes into the markets in three forms. You have the data, you have the expectation, or what the central bank analysts are basically saying. What do we expect inflation to be now versus 3 months from now? And then lastly, you have inflationary pressures. Okay? So the organizational structure of the Federal Reserve. So the way the Federal Reserve is set up is as following. All right? So you have basically three structures to the Federal Reserve. First, you have the Federal Reserve Board of Governors, which is all the guys that are at the Fed in Washington. Then you have the regional district banks, of which there are 12. And then you have these two groups coming together to make the Federal Open Market Committee, otherwise known as the FOMC. So the Board of Governors plus the Federal Reserve district banks, they come together and they form the FOMC. Okay? So the way that it works is that members of the Fed Board of Governors are appointed by the President of the United States of America. So here. Let's go back to here. These guys here, the Federal Reserve Board of Governors, right? These guys here, right? They are appointed by the Federal Reserve Board of Governors. So these guys here, these 5 people here, they have been appointed by the president. And the interesting thing about the current structure here is that with the exception of her, this guy, this guy, this guy, and this girl, they've all been appointed by Trump. Trump hand selected all these guys to be on the Federal Reserve Board. Now, you can see here that there are 2 vacant spots, right? The Federal Reserve Board has 7 spots, right? But as of now, only 5 spots have been filled. Okay? Okay, so sorry guys, just give me 1 second. Okay, so as of now, 5 of 7 positions have been filled. So you have 2 vacant positions still available for Trump to elect whoever he chooses, right? But even though if Trump selects somebody, they still have to go through the congressional process, which is how this works here, right? So the way it works is that Trump selects a candidate. That candidate gets voted upon by Congress, and if Congress approves, they will then get a They will then get a spot in the Board of Governors of the Federal Reserve, right? Or this one right here. It's the same thing. Okay, so that's essentially how it works. And this is the only time in which government has power over the Federal Reserve. All other times, governments have no power over whatever the Federal Reserve does. Okay, so furthermore, on the Federal Reserve structure, each president of the Federal Reserve's regional banks are appointed by a private board. So this is where the privateness of the Federal Reserve comes from. So as you can see up here, there are regional banks. In fact, there are 12 of them, all right? And these regional banks, the president gets voted in by shareholders, right? Just like a normal corporation, you have shareholders. And the shareholders, they will elect a president to serve this role on the Federal Reserve. That's where the private nature comes in. All regional presidents are expected to participate in the formulation of monetary policies, even though some may not be current voting members. FOMC consists of the following: the Federal Reserve Board plus voting members from regional banks, and the key here, there's a key point here, by default, the president of the New York Federal Reserve serves as the chairman on the FOMC. So this is how that structure works, okay? You have Congress who gives or elects one person, or they can elect up to 7 people to serve as the Board of Governors. Right now, 5 of 7 positions are filled, okay? And then you have the Federal Reserve District Banks. The Federal Reserve District Banks, of which there are 12, right? And the 12 presidents are voted in by shareholders to serve as the president, okay? Now, of the 12 banks, only 5 of the 12 members in these banks have a say in the FOMC, okay? The FOMC is referred to as the Federal Open Market Committee, right? This is the committee that comes together and they make the decision on where interest rates are going within the economy. So it includes all 5 of these guys. It includes all of these guys in a discussion, but only 5 members will be able to vote in the Federal Open Market Committee. Okay? Is anybody confused by that? No, you guys all got this? Perfect. Great. Okay. So these are the current Federal Reserve Board. This here is a map of the 12 Federal Reserve District banks. So get to know this very well if you care about how the Federal Reserve really works, right? There's 12 banks. They include Boston, New York, Philadelphia, Richmond, Atlanta, St. Louis, Cleveland, Chicago, Minneapolis, Kansas, Dallas, and San Francisco. Okay. Now, the way that it works is that, as I mentioned up here, there are 12 Federal Reserve District banks, but only 5 of them will have a vote. They all participate, but only 5 of them will have a vote on this. And the way that it works is it's a rotational basis. So what that means is that every year, the 12 banks take turns getting a vote, right? So each president of that bank, they take turns and they get a vote. So for 2019, these are the banks that have a vote, right? So you see here 2019, Chicago, Boston, St. Louis, and Kansas. The presidents of these banks all have a vote. And you'll see here, as I mentioned earlier, New York, the president of New York serves as VP. All right, he serves as the vice president on the FOMC. Okay, the president of New York always gets a default vote on interest rates. Right? Anybody knows why? Anybody want to take a guess why? New York always has a say when it comes to interest rates.
They have a bigger stock exchange.
No, the stock exchange represents all of the country. Who do you think is worth the most? Of all the central banks here, who do you think is worth the most?
Probably New York.
Yeah, New York is the biggest. Because New York is the biggest, it serves as the vice president for all members. Okay? Here, the Hawk scale, you guys shouldn't worry about that. The Federal Open Market Committee. So let me reiterate this again, okay? The FOMC consists of all participants on the Board of Governors of the Federal Reserve System, right? So everybody participates. However, the president of the District Bank of New York, he serves as the vice chairman on the FOMC by default, simply because the Bank of New York is the biggest bank of all 12. The Federal Reserve Bank of New York has the Fed's trading desk, right? So you know the Feds, they hire traders, right? They hire traders who trade their bond market, and that trading desk is located at the New York Federal Reserve. Okay, I've actually been to the New York Federal Reserve. It's a very, very discreet building. You wouldn't even know it if you walked by it. Okay, the other 4 of the 11 remaining Federal Reserve District Bank presidents, they serve on a rotational basis. So they take turns, okay? The way the FOMC works is that they meet 8 times per year to deliberate on interest rates on the health of the economy, okay? So take a look at this. Where is their press release? No. Speeches. Hold on one sec. Meetings and calendars, okay? Look, the Fed, they meet in January, March, April, June, July, September, October, December, 8 times per year that they meet and they deliberate on this interest rate within the markets. Okay, let's take a look at a market like the currency. Okay, the dollar. Oops. No, let's go back here. Let's take a look at the dollar index. Okay, you guys will notice that the market moves in waves like this, right? You know how long these waves last? Every 4 weeks, roughly, you'll have the waves. And the waves coincide with every cycle within the Fed. So you remember the last Fed meeting here in June, right? That was your meeting here in June. That was your meeting here in yesterday. This was your May meeting, right? This was your March meeting, right? This was your February meeting. 2, 3, 4, 5. And then we have 3 more meetings, 8 meetings. You guys starting to see a pattern here in the markets, right? If you guys ever look at Elliott wave theories and things like that, all that stuff is caused by Federal Reserve pricing in of their decisions, right? So you have things such as like the expectation of the event and the run-up. Then you have the event itself, and then you have the aftermath. They last in 4-week cycles. 4 weeks, so like right now, this is what we call the run-up to the next event, right? The run-up to the next event, you're going to see data from the economy, and you're going to see Fed speak telling you about forward guidance. That is going to cause the markets to do a swing or wave in the markets, right? It's going to last for about like 4 weeks. And then when you get close to that 4-week period, you're going to see, okay, in the next month, we're going to get the Fed meeting. What's going to happen? That's going to cause that wave in the markets, right? They last in central banking cycles, right? It's very important to understand this concept when it comes to central banks, because that's essentially how the markets move, right? The stock market does the same thing, but it does the same thing based upon the information that's being released, etc. Okay, so they meet 8 times per year. Scratch this because sorry, this module is a little bit old. Every single meeting, because Jerome Powell took over, every single meeting, you get a press conference. All right, sorry. Let me rephrase that. Forget what I've just said earlier. 4 of the 8 meetings, you get what is referred to as a summary of economic projections, right? That's referred to as your dot plot, which is basically this. Here, you guys see down here where it says meeting is associated with the summary of economic projections. So you see that little star there. Every meeting here. So you get this meeting, the December, the September, the June, and the March meeting. You have that taking place, right? You get a summary of economic projections. Summary of economic projections is just basically an anonymous dot plot that shows where every member of the Federal Reserve Board and the 12 Federal Reserve District Banks, where they feel interest rates are going to be. Okay, so that's basically what happens. These events are extremely impactful, and they'll have high volatility in the market. So if you watch the markets yesterday, like I told you guys, you should all watch the markets, right? You'll understand that these events will have crazy amounts of volatility, all right? So what I meant to say earlier was that in the past, at every 4 of 8 meetings, you would have a press conference and a summary of economic projections. However, nowadays, you have a press conference at every meeting, because when Jerome Powell took over, he basically signaled to the markets that he's going to be giving a press conference at every single meeting. Whereas in the past, a press conference at every 4 meeting was something that Janet Yellen did, and she did that alongside with the dot plot, right? So that's what I meant to say earlier. So I just wanted to clarify that. Okay, so the mandate of the Federal Reserve, Congress establishes the statutory objectives of the Federal Reserve. Their mandate is to utilize the monetary policies to achieve maximum employment, stable prices, and moderate long-term interest rates in the Federal Reserve Act. The FOMC is required to keep inflation in the range of around 2%. So you guys remember earlier when I said they want inflation around 1 to 3? Their goal is to keep it within this nice Goldilocks range of 2%. Not too hot, not too cold, just right. That's the idea. Okay? And then the FOMC defines the normal rate of unemployment as somewhere around 5 to 5.2%. So this is another objective of theirs, is to foster maximum employment, right? So their goal is to stabilize prices. So that means they want inflation around 2%, and they want to, and they are to use the tools bestowed upon them to keep unemployment rate around 5 to 5.2%. Right now, under the Trump presidency, unemployment is like around like it's around like 3%, 3.5%, which is really, really good. It basically means that everybody that wants a job in this economy, they have a job. Right. So these are the two primary mandates of their goal. First and foremost, they want to stabilize inflation. Secondly, they want to keep unemployment around this range. Okay. The Federal Reserve has many tools at its disposal to accomplish this objective. Okay. So the three main policy tools that they have at their objectives is: 1, open market operations; 2, using the discount rate; and 3, making changes to the reserve requirements. Okay. Okay, so the Board of Governors of the Federal Reserve System is responsible for the discount rate and the reserve requirements. And the Federal Open Market Committee is responsible for open market operations. Under these three tools, the Federal Reserve influences the demand for and the supply of balances that depository institutions hold at the Federal Reserve Bank, and in its will alters the Fed funds rate. So this is what they basically do using their tools, right? The Fed and the Board of Governors is responsible for the following, right? And the Federal Open Market Committee is responsible for the following. So first and foremost, the Fed funds rate. The Fed funds rate is the interest rate at which banks charge each other for overnight loans to meet reserve requirements. This is the cost of borrowing money from the highest level in the financial system. Adjustments to the Fed funds rate will eventually trickle down into the system, thereby making it more or less expensive to borrow money in the entire system itself. Changes to the Fed funds rate can trigger a chain of events that other short-term interest, that affects other short-term interest rates, exchange rates, long-term investments, the amount of money and credit, and ultimately a range of economic variables, including economic output and prices of goods and services within the economy itself. So you can see here, this is a long-term chart of interest rates and where interest rates were, and you'll note that the gray areas here were recessionary times, recessions, right, and recessions, right? So since the 1990s, ever since they started slashing interest rates, that's when you can begin to anticipate a recession is imminent, okay? And an imminent recession can happen in about a year, 2 years from now, okay? So take a look at this chart here today, okay? Look what happened to interest rates for the first time in 10 years. This is why today's signal is so important. A recession is possibly imminent. Okay, so this is over here in the last 20 years. Again, this chart's a little bit outdated, but you can see right now interest rates are going down, not up anymore. Okay, more open market operations. So open market operation basically includes purchasing and selling of securities in the open market by central banks. Open market operations are conducted by the trading desk at the Federal Reserve Bank of New York, which is why it's a very important bank. Open market operations comes in two forms. You have permanent OMOs and you have temporary OMOs. Okay, permanent open market operations are generally used to accommodate longer-term factors within the economy. This is basically the Fed's way of buying and selling 30 and 10-year treasury notes, right? So the bond market, they use permanent operations to affect the bond market. They can use temporary OMOs, which is more of the short term. So this is like 1 day to 1 year government treasury notes to address short-term liquidity needs. That is basically temporary OMOs. And all of that is done at the Federal Reserve's Bank of New York's trading desk. Okay? Next thing they can do is affect the discount rate. The discount rate is the interest rate charged to commercial banks and other depository institutions on loans they receive from the Federal Reserve, right? So banks that need to borrow money, if they can't borrow from one another, they can borrow from the Federal Reserve at a slightly higher rate. Discount rates are established by each Federal Reserve's Board of Directors, subjected to review and determination by the Board of Governors of the Federal Reserve. The discount rate for the three lending programs are all they're all the same across all Federal Reserve banks when they change. Discount rates basically fall into primary, secondary, and seasonal credit, right? So primary is like for people with good credit, you get that. Secondaries are for sketchy people or sketchy businesses. They'll get secondary credit, which is slightly higher than primary. Seasonal is for like businesses that operate in seasons, primarily agricultural businesses. Reserve requirements. So fractional reserve banking system, I mentioned this in the Forex modules. It's basically a practice whereby banks accept deposits and make loans and investments for, on those holdings, while only being required to keep a fraction of that deposit on hand. The reserve requirements are the amount of funds that depository institutions must hold in reserves against deposited liabilities. So within specified by law, the Board of Governors has the sole authority to make changes in reserve requirements. Depository institutions hold reserves in the form of vault cash or money market deposits with the Federal Reserve banks. There's more interest on excess reserves, so this is what they pay out. Lastly, you guys need to understand communication policies. How does the Federal Reserve communicate to the markets? So the FOMC holds 8 regular scheduled meetings per year, all 8 of which, not 4, all 8 of which is accompanied by a press conference given by the President of the Federal Reserve. At these meetings, the committee reviews economic and financial conditions, determines the appropriate stance of monetary policy, and assesses the risk to its long-term goals of price stability and sustainable economic growth. FOMC members are required to observe a blackout period regarding policy commissions beginning 7 days before the policy meeting to ensure no leaked information. What that basically means is that they can't talk to any media journalists 7 days before the event. All right. The FOMC is a 2-day event where all the group members meet on Tuesday, and then on Wednesday they come to a decision, and then they have a press conference and they announce their decision. The way it works is that the communication policies that they issue to the market is the following. So you have the FOMC statement, which is released 8 times per year on a Wednesday at 2 p.m. Eastern time, right? Issued at the end of each meeting. It includes the committee's view on economic outlooks and inflation and policy decisions, etc. The FOMC minutes, this is published 3 weeks after the meeting. So the minutes basically summarizes what they've discussed at that meeting itself. That's usually released every 3 weeks. The FOMC chairman usually gives a press conference. So this is where Jerome Powell will testify at every single meeting to provide more insight on economic conditions and policy directions. And then lastly, you have the summary of economic projections. So this is where the dot plot comes into play, and they give the markets, an anonymous consensus of what they intend to do. So this is what the dot plot looks like. It's just dots, and the way the dots work is that you have each member. So you have the 5 Federal Reserve board members, and then you have the 12 Federal Reserve District Bank members, and they're all asked where they think interest rates will be for 2018, 2019, 2020, etc. Right? Well, so not 2018 because this one's old, but you guys get the point. Anyways, what they do is they'll be like, okay, I think interest rates will be here in 2019, it'll be here in 2018, and it'll be here in 2021, right? And as a result, they will log in who thinks what, and they will show you any changes from policy directions from one meeting to the next, right? Or from every dot plot meeting, right? So the idea here is that this is the older one, this is the newer one, right? So you compare the old ones to the new ones. And what it's supposed to do is that it's supposed to give you a comparison of, okay, before most members thought interest rates were going to be at this range. Okay, that's the old one. The new one suggests that most members believe interest rates are going to be at this range. Okay, so taking a look at this, before it was here, now it's here. What is that telling the markets about where the entire group thinks interest rates are going to be? How would you interpret something like this?
That they're projecting anywhere between 2 and 4.
It's tightening.
Well, the way this looks is that most members expect interest rates to be here in this range, correct?
Yeah.
Right? But look here. At the last meeting, somebody thought interest rates was going to be at this low, right? At this meeting, that person has changed his mind and moved his dot up. Is that a hawkish signal or a dovish signal?
Would it be hawkish?
Yeah, correct. It's hawkish, right? How do we know that that's hawkish? Because before, most members were inconsistent on where they think rates are going to be. They're all across the board, right? Now, at this meeting, most members believe interest rates are going to be here. There's more consensus on where interest rates are going to be. That in the market is viewed as a hawkish signal. Okay? That's how you begin to interpret the dot plot and how the dot plot works, right? The dot plot is something that is received 4 times per year, and is referred to as the summary of economic projections. So if we look here, okay, we look here and it says meetings associated with summaries of economic projection, which is in September and December. This is basically telling us that the next meeting, the Federal Reserve is going to give us more information about where they expect interest rates are going to be in the long term. Does that make sense?
Mm-hmm.
Mm-hmm.
Okay, so that's basically what they're trying to say to the markets with the dot plot and the communication policy. So the central tendency and dispersion of FOMC participant forecasts the output of inflation and unemployment. It includes FOMC participants' forecast for the Fed funds rate going forth into the future. Okay. This okay. So guys, I'm gonna stop it here, simply because there's just way too much about the Fed to cover in just one class, right? This stuff here is what really moves the market. So communication policies, understanding the FOMC statement and how to read it properly. This is what really moves the market. So I think I'm going to stop it here. There's a lot for you guys to take in just on the information that I've given you already. That I think continuing forth, we still need like at least another 45 minutes to explain everything. So I think it's probably best to stop it here, and then continue next class with this here. Okay?
Cool.
With that being said, do you guys have any questions so far up to this point?
So you said since the market's always forward-looking, tomorrow's NFP is gonna like the market's not gonna care about the ISM that came out today, right? If tomorrow's a good thing.
No, not at all, Mo. Not at all.
Okay, just double checking.
Yeah. The market is going to look at this, okay? So, review the macroeconomic class, economic data class, right? The market is going to take a look at things like this, okay? Look here. ISM employment. Oops, no. Clear. ISM, oh yeah, here, ISM employment, right? This one right here. You see how that missed or it was lower than expected? Okay, that is like 1 point to the downside, okay? Then it's going to look at, oh wait, sorry, hold on, it's this week. Sorry. Let me go here, okay? ISM came out today. Okay, ISM here. Okay, I look here, ISM unemployment. It came out today. It missed the market's expectation. You see that? All right, that's 1 point to the downside, okay?
That's today, right? Yeah.
That was today. Take a look on Wednesday. Okay? Wednesday, look at ADP employment. Remember, this is the private data that collected employment numbers, right? This is 1 point to the upside, right? So what's going to happen here for tomorrow, right? There's a bunch of other data points. I'm just using these two. There's a bunch of other data points that you're going to look at. What's happening here for tomorrow is this number now, roughly around 164,000, right? It's going to be a coin flip, right? I would say the number would be somewhere around 180K to, oops, to the downside. It'll probably be, to the downside, it'll probably be maybe like 140K. The downside, and anything within this range will be like in line with expectation. It's not like oh my god, the economy's falling off a cliff because we miss expectation by 20,000 jobs, right? This would be in line, but anything below 140 would be like, oh fuck, maybe the U.S. economy is not as strong as we think, right? Anything above 180, it'll be like, oh man, the interest rate cut. Why did we even cut? Like we got a hike, right? That's what the markets will be interpreting it as. Okay.
Mm-hmm.
So that's the idea. Tomorrow's number is going to be very, very big. So I'm going to be watching those numbers tomorrow. Okay. Any other questions?
No, that's it for me.
That's it.
Yeah. All right, guys. So yeah, have a good evening, and I'll see you guys next class where we will finish up the rest of the Fed and then cover international central banks. All right.
All right. Take care.
All right, man. Take care, bro.
Have a good one.
Yeah.